Good day and welcome to Tata Elxsi's Q4 and annual audited financial results for FY2024 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I hand the conference over to Mr. Shashank Ganesh from EY. Thank you, and over to you, sir.
Thank you very much. Good evening to all the participants in the call. Good morning for joining us from the Western side. Before we proceed to the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. Therefore, it must be viewed in conjunction with the business risk that could cause further result performance or achievements that differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results and answer your questions today, we have the senior management of Tata Elxsi, represented by Mr. Manoj Raghavan, Managing Director and CEO, Mr. Nitin Pai, Chief Marketing and Chief Strategy Officer, Mr. Gaurav Bajaj, Chief Financial Officer, and Ms. Kaveri Sriram, Company Secretary. We will start the call with a brief overview of the past quarter by Mr. Raghavan, followed by a Q&A session. We'd appreciate your cooperation in restricting yourself to 2 questions to allow participants an opportunity to interact. If you have any further questions, you may join the queue, and we'll be happy to respond to them as time permits. With that, I'd like to hand over the call to Mr. Manoj Raghavan. Over to you, Manoj.
Thank you, Shashank. Good day to all of you joining us for the earnings call for the fourth quarter and for the full financial year 2023-2024. FY24 has been a year of consistent operational performance with a revenue growth of 13% despite global macroeconomic uncertainties and volatility in the media and communication industry over the last few quarters. We have done well to maintain industry-leading EBITDA margins at 29.5% for the year, even while we continue to invest in expanding our talent base through all the 4 quarters, with a net addition of 1,535 Elxians through the year. When I come to a summary of the financial performance in FY24, our revenue from operations were at rupees 3,552 crore, a year-on-year growth of 13%, EBITDA margin at 29.5%, PBT margin at 28.5%, profit before tax grew 11.9% to 1,048.7 crore. And actually, this is the first time our full year PBT crosses rupees 1,000 crores. Coming to the summary of the financial performance in Q4 of FY24, our revenue from operations came in at rupees 905.9 crores, a growth of 0.9% quarter-on-quarter, and growth of 8.1% Y-on-Y. And the operating revenue growth, actually on constant currency basis, was a degrowth of 0.6% quarter-on-quarter and 7.2% growth Y-o-Y. EBITDA margin came in at 28.8% and the PBT margin at 27.9%. The Board of Directors have recommended a final dividend of 700%, that is rupees 70 per equity share, of par value of rupees 10 each for the financial year ending March 31st, 2024, subject to the approval by the shareholders of the company at the AGM. We had laid down a strategy of integrating a design business deeply with our key industry verticals, complementing our software and digital business with a design-led proposition. This is now complete with a seamless end-to-end proposition from ideation to market introduction. This is enhancing our competitive differentiation, providing early visibility into customer product roadmaps, and creating larger downstream development deals. Over 90% of our industrial design and visualization revenues are now directed to customers in our 3 main verticals, while the remaining comprises of innovation and design-led projects in other industries, including consumer packaged goods, retail, energy and utilities, manufacturing, adding diversity to the application of digital design and seeing possibilities for future verticals for the company. This has been classified as others in the segment report. Starting with this quarter, we are reporting this integrated view of our industrial design and visualization business in all three verticals and not standalone. So our software development services, SDS, combines the erstwhile EPD revenues and IDV revenues into the respective verticals as one segment, with the system integration and support constituting other segments. Now let me provide a summary of the key industry verticals and segments for the company. Look at our transportation business. During the financial year, our transportation business grew strongly at 20.5% year-on-year in constant currency terms, and now accounts for almost 50% of our overall SDS revenues. Out of this, the work that we do for OEMs constitute over 56% of our overall transportation business, and we now embedded into the SDV programs of 5 global OEMs. This business grew at 1.2% quarter-on-quarter in constant currency terms, despite delays in the planned scaling of SDV large deal that we have been awarded previously. I'm especially delighted with the German Design Award 2024 for our work on automotive HMI, which underscores the design-led proposition that we're now delivering to customers globally. We have selected into the SDV program of another global OEMs and are ramping up teams to support infotainment, ADAS, and EV software tracks over the next few quarters. The quarter also saw a digital technology-led deal in the rail segment for development of an advanced collision detection and warning system for a rail operator in North America. This leverages advanced sensor technologies and AI to provide an early warning system. Coming to our healthcare and life sciences business, this business registered a growth of 7.6% Y-on-Y in constant currency terms in the financial year. We have established a strong foundation for continued growth with addition of 5 marquee customer logos in the year and expanded capabilities and platforms in new growth areas such as digital therapeutics and connected health. The Offshore Development Center for Innovation and R&D we announced in March 2024 for Drago Medical, German headquartered leader in critical care and safety equipment, demonstrates the relevance of the technology and design expertise and deep domain capabilities for next generation healthcare. We are investing and winning deals with GenAI-led solutions for the healthcare industry, including identification and elimination of toxic materials in the medical device supply chain. We are building platforms and winning deals for digital therapeutics, an emerging and strongly growing team for the healthcare of tomorrow. Coming to the media and communication business, this business declined 2.6% in constant currency terms during the financial year. This quarter saw a merger-led impact of a deal ramp down with one customer. However, considering the severity of challenges in the media and telecom industry, we have done well throughout the year to protect business, add marquee customers, and increase wallet share with key customers. We are seeing growth in operator revenues and our overall customer base. Even as customers continue to tighten budgets and optimize spend, we believe that there are opportunities in contributing to the revenues through advertising technologies or ad tech and enabling OpEx reductions, automation, and transformation of network operations. We are actively investing in offerings, platforms, and partnerships in both areas. Both leverage AI and GenAI to deliver speed and autonomous operations. We're delighted with Neuron, Tata Elxsi's network transformation and automation suite, being declared the platinum winner of the Juniper Awards for Telco Transformation. It was also the center stage of a showcase at the Mobile World Conference in Barcelona in February. The power of a design-led proposition is best underscored with a multi-million US dollar program we won late in this quarter for the customer experience transformation of video services of a leading Africa plus Middle East operator operating in over 25 countries. This also demonstrates new opportunities for us in new markets such as LATAM, Middle East, and Africa. Coming to our system integration and support business, we continue to pivot to value-added services, innovation-led projects such as experience centers, and supporting downstream deployment and run management of our products and platforms. Q4 revenues and growth was impacted by hardware shipping delays due to the Red Sea shipping crisis, which did not allow us to deliver and build some revenues. Despite this, It grew credibly by 18.6% in the financial year 24 in constant currency terms, getting close to a 100 crore business in this financial year. From a customer standpoint, we are transforming our customer base across industries with a significant shift towards OEMs in the automotive industry and operators in the media and telecom industry. While we continue to invest in deepening our key customer relationships, this is reflected in the strong growth in our top 10 and top 25 customers across the company. From a talent perspective, we continue to invest ahead of time in building our talent pipeline. We are expanding our presence across locations in India and overseas. Our employee retention continues to be the best among our peers and industry at large at 12.2%. We added 178 Elxians net additions in the fourth quarter and 1,535 Elxians in the full year. And we have a planned intake of fresh engineers and laterals through FY25. On the AI and Gen AI front, we continue to invest strongly in solutions, POCs and projects, and ramp-up of talent across the company. We have created and deployed specialized programs to be able to get 25% of our engineers AI ready by Q3 of FY25. We are working on experimenting and innovating using Gen AI across design and software. We are targeting areas that may be impacted by Gen AI and disrupt our business, such as coding, automated testing, that we proactively take to customers. Equally, we are applying Gen AI to workflows and processes, regulatory work, automation and network operations as a new service, frameworks and solutions we can take to customers. Large deal that we announced in the healthcare regulatory space already uses automation and AI to deliver efficiency, speed, and higher quality workflows for our customers. We are also enriching our in-house platforms such as Neuron, ICX, eCare with Gen AI to enable new use cases and customer experience. In the quarter, we also hosted a Gen AI hackathon internally for our employees with over 36 teams participating across our industry segments. Even as we step into the new financial year, we are pleased to announce two new members to the board. Mr. Soumitra Bhattacharya has had an illustrious corporate career, especially in the automotive industry, with over 28 years with Bosch Group. He serves as the chairman of Bosch Limited and is a director for ISQM, an industry-led initiative focused on quality excellence and innovation. Mrs. Ashu Suyash is a highly respected leader and served as an MD and CEO of CRISIL, among leadership roles across many leading institutions. He has recently set up Colossa Ventures, an investment ecosystem for women entrepreneurs, and is an independent director on a few boards, including Hindustan Unilever. We look forward to leveraging the rich experience and network, industry knowledge, and strategic inputs from the new directors. In summary, I'm pleased with our overall performance and resilience in revenues, margins, and customer additions throughout the year in a volatile macroeconomic environment. We are entering the new financial year with a commitment for growth and a continued confidence in a differentiated and integrated design digital capabilities. This is backed by strategic relationships we have built over years with key customers, the qualitative change in revenues towards OEMs and SPV programs, entries into new operators and marquee healthcare logos, the investments in talents and hiring that we have made and continue to make, investments in strategic technology areas and AI, and a strong deal pipeline we carry into the new financial year. Thank you, and we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Hey, thank you. Two questions from my side. Firstly, on the media line, can you just give more color in terms of whether it was in the media vertical or in the telecom space? And if you can quantify the ramp down as well, for the quarter? And is this something which is completely done, or should we expect some further ramp downs in the coming quarters as well? And the second question is on margins. We saw margins decline by more than 100 basis points this year. So how should we think about margins for next year, given that the demand environment has not changed? So I'm targeting to maintain margins, or we still have some levers where we can see margin expansion. Thank you.
Yeah. So I think the dip that we had with one account was in the media operator segment. It impacted almost 3%. That's one single degrowth that we've had with one customer. Coming to the margins, I think we are pretty confident with the sort of pipeline that we have, and the levers that we have to manage our margins. So we are definitely looking to come back to the margins for the full year that we delivered in the last financial year. So I think that is what we would focus on.
Yeah, just to add, Bhavik, we are done with the ramp down. So that doesn't continue or decline further.
Okay, just a clarification, this 3% impact is for the quarter and overall level, right?
No, at the MCV level.
At the MCV level.
So media and communications, if you note, was just a little more than 4% for the quarter, out of which about 3% was attributable to the single customer and the single ramp down. We are done with that this quarter. So when we start the next quarter, we have no further impact from that customer.
Okay, got it. Thank you.
Yeah, otherwise, we would have ended up just about neutral. So that's the point.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Sulabh Govila from Morgan Stanley. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is on the transportation business. So just wanted to understand that there are multiple moving parts in the sense that on the one hand, we have OEM-related business where we see SDV projects, coming in, and then at the same time there's a delay in the form of ramp up of some of these projects, and also ex of OEMs, some of the tier one business could be coming off. So just wanted to understand that. Right now, the sort of growth that we've posted, which is 1.2% Q-on-Q, when can we think about this accelerating, given that there are multiple moving parts there?
Yeah, it is. As we rightly talked about, currently 56% of the business comes from OEM. So if you look at it in the previous financial year, I think our tier one business was more like 60% and OEM business was more like 40%. I think we've done exceedingly well to transition this into a lot more focus on the OEM business and the sort of deals that they've been winning. There have been some delays in one deal that we have won, but we definitely see that ramp up picking up for the later half of this quarter. So I think our focus is to continue to exploit the opportunities that we see in the OEM business. Tier ones, we used to have a large portfolio of tier ones. So what we're really focusing is to really focus on select key tier ones that we believe will continue to grow strongly. And in these tier one businesses, we are looking at consolidation opportunities. So we are not abandoning the tier one business because we still believe that there is opportunities there. And there are a lot of consolidation opportunities that we are bidding for at this point in time. So that is something we will strongly focus on. And we hope that the delays and the issues that we're seeing in the industry over the next this quarter, we will see that coming to a close, and we'll hopefully be able to ramp up on all the deals because we have done all the necessary work that is needed for preparation. We have the pipeline available, so it's a question of ensuring that we ramp up and customer decisions are taken and we move forward.
Okay, understood. And my second question was on the media vertical. So I just wanted to understand that while you mentioned that this particular ramp down is now over, and you also see some of the opportunities in other parts of this vertical. So just wanted to understand that from a overall outlook for this vertical in the coming quarters, versus what we've seen overall in the last year, which is sort of a decline for the full year. So should we expect in the coming quarters an improvement in the outlook for this vertical, given what you see today?
We believe that we've bottomed out in Q4 for this vertical. We have, of course, internally we have done some amount of restructuring in the way we go to market in this particular vertical. We made some strategic choices. I'm pretty confident that we will see growth coming back into this vertical as we move into the Q1 and Q2 of this financial year. So the pipeline is building up, and I'm pretty bullish that we will see a recovery.
Understood. Thanks for taking my question. I'll get back in the queue. Thank you.
Thank you. The next question is from the line of Vimal Gohil from Alchemy Capital Management Private Limited. Please go ahead.
Yeah, thanks for the opportunity. So two questions on auto. Firstly, on the deal ramp up, last quarter we had roughly 2% growth. We would have expected that with the deals that we had one in Q2, they would have contributed in Q4. And so will this 1.2% growth include those ramp ups, or this 1.2% has come without that? Because we are talking of the delays in the deals that we won in Q2 as well, right? So how should we think about that match?
So that we have ramped up a very small team, so the full ramp up has still not happened. So you can practically say that 1.2% doesn't include any ramp up of that deal. So we're expecting that ramp up to happen in the later half of Q1.
Right. So basically the ramp up has already started.
Yeah, a pretty small ramp up has started. The actual deal is a multi-year deal, but we have not been able to ramp up to the initial expectations because we have got some customer related issues, and we're hoping that will get over towards the end of this quarter.
Okay. And how much has our OEM business grown as compared to FY23? What was, if you can give me the number?
The OEM business was 40% in the last financial year. This financial year, the FY23 was 40%, FY24 was 56%.
Okay, so this 56% is for the entire FY24, not for Q4.
Correct. No, entire.
Yeah, so Vimal, maybe I can just add, the OEM business grew by about 40% year on year.
Okay, which implies that there's a significant decline in the tier 1 now.
Yeah, that's correct.
And we've bottomed out, that is what you're saying.
That's right. Yeah.
Okay. And next question is to Gaurav. Maybe if you can help us understand the puts and takes for the margin performance this quarter.
Sure. So margin came down by 100 basis point. 30 basis point came from the cross currency headwinds. While we continue to invest and expand our talent base to capture the capability and capacity building, and also keep investing into the talent pool in terms of the AI capabilities. So 80 basis point came from that cost towards those talent building, and people got added in the quarter. We also done with the last batch that we onboarded for the 23 campus in this quarter. That together 30 basis point from exchange and 80 basis point from the people rate investment capability building, and give a total 110 basis point there. At the same time, we have some benefit from the cost of sales that we got optimized. That gives us a benefit of 10 basis point, and hence the total EBIT drops from the quarter to quarter basis came at 10 basis point. But if you see at the overall company level P&L, if you see the cost has not significantly changed, just, in the quarter there was a certain headwinds in one, few of the verticals, hence the revenue got hit, which has a, impact on the margin. But at the same time, we see there enough capacity available to tap those, levels available for us to, get to the, the margins where we operating for the full year in FY24.
And last clarification is the erstwhile IDV business, which we have now merged with the software business, that gets reported between media and comms and the other verticals, right? It does not, nothing gets added to auto.
No, in fact, it does. It all the three verticals. It adds all the three verticals. In fact, what has happened is, just to explain, why we had to do this. We have been, talking about our integrated, design digital, offering and taking a design-led solutions to our customers. So we have been winning a number of integrated deals, and depending on which division was really leading it, revenues are accruing to that particular division. So in some cases, IDV used to get the revenues. It was not only the design revenues; it also included the software revenues. In some cases, the transportation or the media and communication vertical, they were getting the complete revenue. So it was sort of little misleading in terms of how to segregate what is design and what is, the EPD offerings. So, and it was getting very difficult to go on a case-to-case basis and make this differentiation. So we decided that, look, let us have an integrated, EPD plus IDV offerings, because it no longer made sense to really differentiate, what is EPD and what is IDV. And this value proposition also resonated very well with our customers, and it only makes sense when we look at it, when we give an industry breakup for all our revenues. We were only giving the EPD revenues, and that was sort of misleading because 12-13% of our revenues which used to come from IDV were not represented in this breakup. So to apple to apple comparison with, if you want to compare peers, if you want to compare us with any other organization, it makes sense for us to give an integrated, what is the total, market share from out of all the revenues that we are generating, how much is automotive, how much for media and communication, and how much for healthcare. So that was the reasoning why we decided that, look, it is better to give a full view to the investors.
Thank you so much, sir. Thank you.
Thank you. Next question is from the line of Manik Taneja from Axis Capital. Please go ahead.
Thank you for the opportunity. I hope
Yeah, we can hear you.
Yeah. Manoj, basically just wanted to get your thoughts on 2-3 aspects. Number one thing was that we've seen some of your traditional IT services companies acquire ER&D companies with deep customer relationships in some of the large OEMs. So how do you think that, coupled with the fact that as customer spending moves towards middleware aspect, how does those two aspects impact competition for the ER&D companies like ours? That's question number one. The second question was with regards to just understanding your prospects in terms of FY25 in terms of growth across different industry segments. Like this year, growth was led by automotive in a very significant manner, while we had some challenges on the media side, while healthcare started to pick up towards the later part of the year. So how should we be thinking about the growth dynamics across the three industry segments going into FY25?
Sure. So I think, it is a fact that we have seen large IT services companies trying to get into the ER&D space, especially the automotive space, by acquisitions, and that is a challenge that we need to face. I don't have a big view on it. We would treat it as any other competition, but however, we are pretty confident on our design digital offerings, that we have. And we have built the capability organically over, many years, right? Almost 30 years we have been in this business. So we clearly know, what ticks in this industry. We have built the processes that we need to deliver value on a sustained basis to our customers. And many of the relationships that we have with our customers are, more than 10 years, 15 years, 20 years of the relationships that we have. So yes, we are looking at some of the news that we read in terms of acquisitions and so on, and we will take it on a case-to-case basis. From our side, we are deeply focused on our existing customer base. We are really deeply focused on building our executive connect and deepening our relationship with our existing customers and ensure that we grow with those customers. So coming to FY25 growth, we don't usually give our guidance, but I believe that I'm very happy with the sort of growth that we have seen in the automotive industry in the last financial year, and the push for us is to really repeat that sort of a performance. At the same time, to really see how we can. I talked about bottoming out of the NCV business, really hoping that NCV business will start, contributing to the growth of the organization. I'm pretty excited with the HLS business. That we've had a issue with MDR, and as a result of which our growth rates slowed down in the last financial year. I think we've put all of it behind us, and we really hope that we'll be able to accelerate that in the financial year. So, I strongly believe that we should be able to put up a better performance from a growth perspective as compared to last financial year.
Okay. Yeah, sure, please.
Add a little bit from my side, and there's another year, especially because I'm a little closer to some of these MAs that we see and read about. My comment would be as follows, right? I think one, we're in the right space in terms of the industries that we work in, the fact that we have a presence in automotive, healthcare, and so on. I think these are the segments that are growing. Two, I think we've always been in the right service lines. Very, very important. Software and electronics is where all the growth is, and I think we are absolutely in the right place for where growth is going to be. Three, I think we're winning the right deals. If you look at the pivot that we've made over the last few quarters, I think you're seeing not just the significant growth that we're driving from OEMs, but from the right kind of deals, including SDV. And lastly, I think we are in the right country, because your scale, your capacity, your ability to deliver will all come from India. In my view, I think some of the acquisitions that we see is the fact that we have the right ingredients and the right ticks in the right boxes. And many of the acquisitions are just an attempt to get into the same space with possibly companies that have relationships, legacy capabilities, and now they have a lot of lift and shift to do.
Mm-hmm.
That's the way I would do it.
If I can throw you on one more question. So, like you mentioned that we certainly expect FY25 to be better, mentioning what is out of media and communications vertical, and why transportation expected to do well. Given some of these ramp-up challenges on the transportation side in the near term, should one probably be expecting growth improvement to be more back-ended, with possibly near-term being as something as what we've seen in more recent past?
We will grow out of it, right? I mean, we've had a issue in our media and communication business in the quarter. We definitely will grow out of it in the quarter. Similarly, from the transportation business also, if you look at it, we will grow out of where we exited last quarter. So, in my perspective, we definitely will do better, including in Q1, and that momentum will carry forward through the financial year.
Sure. Thank you on this.
Thank you.
Thank you. The next question is from Apurva Prasad from Elxsi Securities. Please go ahead.
Yeah, good evening. Thanks for taking my question. So, Manoj, I wanted your thoughts on how should we look at the trade-off between growth and margins. So what I'm trying to get at is, would you rather be okay with growth at the current levels and the 30% margins, which is what you have maintained in the past, or do you think there is a business case for reinvesting some of these higher margins to chase that growth?
The mandate for our board is very clear, Apurva, and I've maintained this repeatedly, right? So we can't chase growth at the cost of margins. So we definitely need to maintain our margins as well as look at growing at a faster rate, right? So the focus from our point of view, from management point of view, and the strategies that we have in the organization, the sort of investments that we are making is all towards accelerated growth without reduction in margins.
I think what we're also saying is that we have enough levers to make sure that we can support the strong growth that we want and we are looking to without sacrificing margins. So I think the point we're making is that the kind of net hiring that we've done over the last 8 to 12 quarters, in fact, you have to step back to look at the fact that we've absolutely been consistently hiring in large numbers all through the last 8 to 12 quarters. Not all of it consumed for sure. So we've been building capacity. So to that extent, I think there is enough levers.
All right. And to the earlier point that you were making, which are the sub-segments that could be doing much better? So you mentioned, I think, OEMs, which grew 40% for the year. Would you expect a similar run rate in the OEM sub-segment? And which would be some of the other pieces within the business that you expect to go faster?
Yeah, we won't comment on the growth rates, but definitely what we can call out is to say that we expect the OEM part of the business to continue to grow strongly because of the fact that we already won deals and have a path to ramping up. The other is we continue to focus on more. Right? So to that extent, I would definitely call out that piece as one of superior growth overall, and nothing to do with last year. So I'm not doing a comparison. The second is in the media and communication industry, I think we still have a lot of faith in the relationships and the capabilities that we bring to operators. So we definitely see stress in suppliers and device vendors and so on, just as much as we've seen the same in the tier one suppliers in the automotive industry. I think the operator pivot that we've made and